Hey traders, today we're going to be finding your trading edge using a data-driven approach. Hi, I'm Mac Daddy Trader, and if you don't know me, go ahead and hit subscribe so that way you can be one of the first people to watch my next video after you hit that notification bell, and give a like if you liked what we're talking about. So let's get started. And first and foremost, this is for entertainment purposes only and not financial advice. Why finding your edge is crucial. Trading success is not based on pure luck, but on statistical probability and risk management. Today, we're going to be talking about the statistical probability portion of this, and we'll save risk management for another video. But a trader's edge is defined by consistent profitability over a large sample of trades. That large sample is something we're going to talk about too, because that affects your accuracy of your actual win rate and what it means to have that win rate. This presentation covers the key metrics and visual tools to identify and refine your trading edge. So, why does sample size quantity matter? Okay, small sample sizes can lead to large variations in win rate accuracy. Here we have a sample size of 10, and with a 95% confidence level, we're going to have to tack on a 30% to 31% variance buffer on this. So let's say after 10 trades, you have a 65% win rate. That's not entirely accurate. I mean, for those 10 trades it is, but long-term projection, you're looking at a variance of 30% on either side. So it could be as low as, 45% or as high as 90%, okay? So it's just relative to your sample size and what you can expect to have at a 95% confidence level with a certain percent of margin of error. So your margin of error is at 30% with 10 trades, and it changes the more samples you have. Now, ideally, you want to get into this range where your percentage does not affect your overall profitability, your percentage for margin of error. And that typically falls around anywhere from 200 to 400 if you're trading certain risk reward ratios. But if you're trading extreme ones, then you kind of start need to have more robust sample size selections. So you may need to start trading here. Unfortunately, for most retail traders, you only have a limited amount of data sample size to choose from, and so that's going to dictate and limit what your ability to optimize is, or optimize for is. The margin of error shrinks as the number of trades increases. So as you can see here, margin of error percentage goes down as your sample size goes up. So 10,000 trades, your margin for error is 1% variance with a 95% confidence level. So that's not saying that let me tell you what it is saying. It's saying that after 10,000 trades, if you have a 90% win rate, your margin of error for that is 1%. So you could either have a 91% win rate or an 89% win rate with a 95% confidence level. So you can say with 95% certainty that you're going to be plus or minus 1%. And typically that's good enough for most people, but some quant and hedge funds may differ on that and have their own secret sauce that they want to keep secret. Most trades equal greater statistical confidence, or more trades equal greater statistical confidence in your win rate and system performance. So yeah, the more the better, but you start getting diminishing returns when you go from 1,000 to 10,000. So the effort that you're trying to put in is probably not worth it at that point, and unless you have some way to efficiently optimize. Equity curves and risk reward strategies, understanding different risk ratios. Okay, so different risk reward strategies are going to impact both profitability and variance. When you have like a 3x, basically saying 3 times the amount of your loss or your wins are 3 times the amount of your loss, you're going to have a lower win rate, but it's going to deliver larger profits each time you win less frequently. So what that means is if I go over here and say I want to have 72 as my profit taking level, and I only want to have let's say 24 as my stop loss, then yeah, my win rate's going to be super low, but I could be just as profitable as the person who's taking 1 to 1 and doing a 48 and 48. And I could be just as profitable as the person who is trying to do 80% win rate, taking 18 ticks of profit with 72 ticks of stop loss. So it's just a gradient. And by the way, this is just a baseline, no um, no fancy things attached. When you have a 1 to 1, you're at a coin flip, and everything else, changes based on which way of this gradient you go. So a 90 tick profit with a 18 stop loss, match them together, you get a 16.7 win rate. So you're going to be more on this side. If you have a 12 tick profit with a 72, you 85, so you're going to be more on this side. You're going to have more frequent wins, and statistically your losses are going to be greater each time, or they're going to weigh more relative to these losses, which are going to be smaller, just based on your risk reward ratios. Which one is best depends on your personality and optimization limitations. So what I mean by personality is maybe you like winning a lot, and so you prefer the inverse risk reward ratios. And maybe you can stomach those big losses and grind your way back up to where you were before you lost. And also you only have to worry about smaller win or loss streaks compared to this high uh, this low win rate scenario here. Conversely, this low win rate scenario, maybe you like the big wins. Maybe you're okay with slow losses that eat into your profits for longer, but when you do win, you win big and it covers all your previous losses. So it's just a mindset, and everyone's different. They all fall into somewhere in here. Some people like the fringes, other people like the quadrants, other people like dead center. So maybe we could do a game in the Discord where we find where we like to be. That'd be kind of fun, I think. And we can have some quadrant areas and a poll to see what our Discord likes. Let's go to the next slide. All right. Equity curves and risk reward strategies, understanding different risk reward ratios. Don't forget on this, your commissions and slippage need to be taken into account. Commissions are the cost of getting in and getting out for each contract. So you have to pay the house or the broker to be able to play the game. All right, and then slippage is the cost of unfavorable entries. So if you're getting terrible entries, you're too slow, you're not automated, or you just forgot what you were doing and then you got in late, that's slippage and that cuts into your profits, okay? Because your strategy is based on whatever it is that you decided to base it on, and any deviation from that that's not taken into account is going to be forfeit. So just even here with a 1 tick commission added to our previous stop loss and take profit win rate matrix, we already have an issue where it's no longer a coin flip. The house has the edge, and over the long term, you're going to be unprofitable. So now your break even is even higher before you can start being profitable. You would have to have a higher winning rate strategy in each of these blocks, because remember, this gray area used to be break even at 50%. And now look at it, 54, 52, 51. Now notice how the numbers are going down, which in relation to the grand scheme of things here, the higher profits you have per trade, the less the slippage, the commissions, and everything that's not accounted for impacts your overall profitability take home. So the higher you go on this, the less percent it's going to matter. You're actually going to take back some of your long term um, gains, because it went from 54 down to 52, and now it's getting closer and closer to 50. So progressive, but still noticeable. Okay. Um, Same thing here. On the previous slide, let's just go back one. Uh, 6 take profit and a 90 stop loss. We're at 93.8, but now we're at 94%. So don't forget your commissions and slippage. This one is just for commissions. You may want to add an extra tick or two and recalculate this matrix to incorporate slippage. All right? It's very important, because you could say, "Oh, well, I'm above 50%," and let's say I'm 50-50 at this 48 level, right? I'm above 50. Well, yeah, but you're still break even, okay? And even this may not be correct because of slippage. So let's say this, in all actuality, to break even, you need 55%. But don't forget, what was your sample size for that? So your margin of error could be even more. So let's say you only took a sample size of, I don't know, whatever gives you a 15% variance or a margin of error. I think that was, let's go back real quick. 15, somewhere in here. Let's say you took 50 trades. 50 trades right here at, oops, 50 trades right here at, let's just do this one, 48 and 48. All right, 50 trades, 15% variance. Okay, always go to the negative side. So you're looking at 15% of 50. Let's pull out the old calculator real quick. And for all you math wizards out there, follow along. 50 times 0.15. So 7.5. So you're already going to be at below 50 by the time you incorporate all those things. And that's way below break even, and you're floating around somewhere in the negative profit factor zone, which we'll talk about a little bit later. All right. Another thing you want to not forget is your instrument selection. Your instrument selection matters. It affects multiple aspects of your trading strategy. The impacts on you have high impact on commissions when you change what instrument you're using, especially in this scenario right here where I have my minis, where we're trading minis. I went ahead and did a 10 times smaller take profit and stop loss as a derivative of NQ for, or MNQ for NQ, and then I did 3/5 tick commission, because let's say I was using $5 for commissions on NQ, and then now I'm using $3 for MNQ. That's still a huge percentage that wasn't necessarily taken off all the way to match a 1-to-1. So now I have 0.6 take profit instead of 6, and same for stop loss. So stop loss, take profit, also that affects your functional tick size. So because we have smaller ticks that we're playing with, and the commissions are still relatively higher in comparison to the significantly lower amount per trade, we have to play in a higher field in order to offset that big percentage of commissions that are being taken out. So as you can see here, if we tried to trade on a 1-to-1, let's say a 1.2, which is a 1-to-1 risk reward ratio, instead of having a 50%, we need to have a bare minimum with just commissions related, 66.7%. Okay, that's insane. So that's kind of a ripoff when you're playing this small with all of the granularity going on there. So what you're going to have to do is you're going to have to go along the spectrum until it evens out a little bit to where you're not paying as much for what you're trying to do. It does go down, but as you can see, it doesn't go down all the way. We're still at 51, over 10,000 trades. You're going to be a little bit less than where you started because it's not a coin flip anymore. The house still has the edge. So you always want to make sure that your break even levels are based on, your sample size, uh, margin for error, your tick commissions, your or commissions and ticks, your instrument selection, your and your slippage. So those are just basic things to look out for, and you'll find yourself somewhere in this gradient. Okay. All right. How losing streaks correlate with win rate. So naturally, you're going to find that higher win rates produce lower max losing streaks. This was a sample, Python sample done over 10,000 trades, various win rates, and the hypothetical max losing streaks and winning streaks that it had. And as you can see, it's inversely correlated. All right. The lower win rates led to longer losing streaks, requiring deeper capital reserves. And that part is not entirely accurate because if it's a 1-to-1 trade off, it's going to be the same amount of capital. It's just going to be taken out at different times and in different lengths of time. So if here you're going to be having the big chunks taken out less frequently, but they're still going to be huge chunks. Here, you're going to have lesser chunks theoretically, but they're going to be taken out more often. All right. So, in the grand scheme of things, it all equals out. But again, you must account for your expected worst case losing streak no matter where you are on the spectrum, because that's going to take into account your risk management planning. So once you calculate what your loss is and you've calculated based on your, sample size, margin for error, your commissions, your slippage, any randomness, anything that you know of that's specific to your strategy that could be a negative influence, and then you find your spot, you check your max loss streak, that's are you able to handle losing 8 times at 70%, 8 times your trade's stop loss. Okay, so you got to be able to handle those things. And same thing over here. Are you mentally strong enough to handle losing 32 times but before winning once? And are you okay with only having a 7 win streak? A maximum. That's not saying you'll ever get there, but that's saying like, hey, the most you'll ever get is 7 in a row. So those are just things you want to take into account. Also, slippage, market shifts, volatility changes, and partial fills can make the streaks even worse. So just keep that in mind. It may not be 4, it could be 7 out of 90%. You just never know. It could be 10 out of 90%. You just never know. Okay? But, statistically, I think if we were to take this to heart, again, not financial advice, but 10,000 trades, that gives us, let's go back, 10,000 trades, that gives us a 1% margin for error with a 95% confidence level. Okay? So that's no Six Sigma there, but that's a 1% variance with a 95% confidence level. So that means you're 95% confident that there can only be a 1% variance on whatever your true win rate is if you took that many trades and your losing streak is this number. Okay? Next, how profit factor defines a system's viability. All right, this is interesting. It's quirky. I love it. Um, Before I start reading into this, I just want to show you this chart. Um, the red area is your unprofitable zone. So whatever you decide, if you want to have if you determine that you want a 1-to-1 and your win rate is 25%, that's an unprofitable strategy. Do something. You got to change it. You can't live here. You're giving money away, and that's not good. So what we want is, let's say we're doing a 2.5-to-1. 15% is not cutting it. Okay, 83, we're getting there, but we're still doing a slow bleed. 1.7, okay, we're at break even. After commissions, fees, we're not profitable, but we're not profitable. Okay, we're break even. 1.35, okay, now we're seeing a little bit more sustained profitability at this 2.5-to-1 risk reward ratio at 35%. At 35% with a 2.5 to 1 reward risk ratio, we're at 1.35 profit factor. Now let's look at that in relation to this area. Profit factor equals gross profit divided by gross loss. Profit factor of 1.0 means the strategy is break even. So that's this gradient, the white lines. Anything above is profitable. Anything below is not. We want to be on this side. While a profit factor of 1.25 to 1.5 is good, anything higher is considered optimal for long-term sustainability. And it must be analyzed in the context of the risk-reward ratio, right here, and the win rate. So it's like a triangle. You got your win rate, your risk, and your reward. And those things all line up and converge on one of these areas. Also, a high profit factor alone doesn't guarantee a smooth equity curve or growth, because we're going to talk about how a profit factor higher than 2 can indicate unrealistically high win rates, which can indicate overfitting, or in the rare case that you're a high frequency quant wizard that discovered some hidden arbitrage that hasn't been depleted yet, go ahead and shoot me a DM and we can talk about your strategy, so that way I can get something out of that too. But for all the rest of you, be very wary of your profit factors being over 2 or 2.5 or anything like that, because you get into an area where, number one, if you have a lot of parameters in your trade setup, that's a sign of overfitting. If you have a small sample size, that's a sign that, your risk of your margin of error risk is high, so it's probably a lot less, and your current is overinflated. So maybe it goes down to, it went from 3.5 down to 0.5 after you did a walk forward test. That's a clear sign that your 2.0 or 3.0 or 4.0 is terrible. But if you have that 3.0 and you do an add a sample test and maybe it only goes down to 2.4, and you do another add a sample test and it goes back to 3, and then it just keeps bouncing in this area somewhere, you have a great strategy. Now that can happen here too, where you're in these like iffy zones but still profitable, and that's where most profitable traders lay, is at this 1.3 to 1.8 area. for a profit factor, and they really like it there because even in drawdown, they're still a little bit profitable, and that covers your taxes, that covers um, your commissions, your fees, everything like that. So you need to be a little bit profitable, and that's where risk management comes in. Anything up here, you need to really check to make sure your expectations are not that high. You need to do a lot of out of sample tests to verify that. And once you do, then and it still works, then you have got yourself a golden egg. All right. Equity curves. Let's talk equity curves. So, the shape and stability of an equity curve are directly influenced by the win rate and risk reward ratios a trader optimizes for. So, I want you to take a look at this is long term, over 5,000 random trades based on these setups. It's just a Python script, nothing fancy. These aren't real live trades or anything, but they're just a random assessment. You can see how uh, let's say this 3-1 big winner, small loser at 26%. It has very huge swings. Okay, that's crazy. And some people might not like that. Some people might like that. And it all depends on when you take your payouts, how you do it, uh, your your uh, your account risk strategy, all that stuff. How you do your account maintenance, everything like that, restructuring. But um, yeah, that's insane. And then you have nice smooth curves. There's still some ups and downs. You have drawdown periods, but it's a lot smoother. You got some more choppier ones, and then you have like these noisy ones down here that kind of have a slow growth factor to them. So it just depends. It's directly correlated. The size and shape of these are directly correlated to how you set up your risk reward win rate triangles. And assuming they're profitable too. Um, Also, you have your risk of ruin. So when you run these simulations, let's say you ran orange simulation 1,000 times, 5,000 trades each, basically scrambling the order of each trade. You could theoretically find a percentage of times that this went and tanked your account, and that's a good way to see robustness of your strategy. If you do a bunch of random samplings and your strategies look more so like this blue one or even this yellow one, then that's a decent equity curve that goes from bottom left to top right without much, crazy variance. Equity curves tell the story of traders' edge over time. The goal is sustained compounding growth right there, not just short term profitability. So, again, your little 10 trade sample size is not a reflection of the overall um, sustainability of that uh, trading strategy. So, because you could cut out uh, a little sample right here and you could see all this drawdown, all that drawdown on this blue one. But big picture wise, look at this. That's a nice, beautiful equity curve with uh, not so violent drawdown long term. Okay? So just keep that in mind. Bringing it all together in defining and strengthening your edge. Let's go over this. Risk reward must align with your psychology and account risk. A higher risk reward strategy, meaning uh, bigger wins and smaller losses, but more frequent losses. You need to be able to withstand those more frequent losses mentally. Whereas a high win rate strategy is going to require more precise entries of execution, and you're going to have to be able to withstand the psychology of losing a bigger pot each time the more infrequent losses happen. Win rates directly determine expected losing streaks. So traders must ensure they can survive the worst case scenario without deviating from their systems. Like previously said, a higher win rate is going to show lower losing streaks statistically, and vice versa. Profit factor alone is not enough. Variance and survivability matter. Strategies that work well in simulations must be robust in real-time trading conditions. So that's going back to back testing specific sample size, and then maybe tweaking it a little bit or not tweaking it, and then doing an out of sample test to see how it did going forward. If it worked, great. Do some more tests out of sample to see if it continues to show profitability. If not, scratch it, go to the next strategy. Strategy validation requires a sufficient sample size. So like I said, benchmark 200 to 450, but you're limited to your data, your historical data sets that you have. So just keep that in mind when trying to come up with something on your own. Commissions and execution fees affect real world results. Always account for spread slippage and other transactions when calculating edge. So keep in mind those outliers that we don't think of when we try and do our strategy. Don't be that guy or gal that just looks at the baseline risk reward win rate matrix and says, oh, if I do a 1-to-1, it's a coin flip at 50%, and that's it. 9 times out of 10, it's actually a higher than a coin flip to even just break even. All right. And that's all I got for today. If you like this video, give it a thumbs up. If you have any questions about what we talked about today, leave it in the comments. If you want an invite to the Discord where we talk about these things and showcase some strategies and just have a great time with a great community, share indicators and all sorts of other things, go ahead and email me at macdaddytraderhelp@gmail.com, and I will get you a Discord invite link sent to you there. Anything else, just hit me up. That's all for today. Thanks for watching, and I will see you next time.